Right now, sitting in your pocket, parked in your driveway, or resting in a field somewhere in America's agricultural heartland is a piece of machinery you paid thousands of dollars to possess. Yet legally, financially, and technologically, you cannot own a single component of it. If a single software engineer in Cupertino, Austin, or Berlin clicks a toggle on an internal dashboard, that machine will instantly cease to function. You cannot fix it. You cannot modify it. You cannot even resell it without corporate permission because you didn't buy a product. You bought a temporary, revocable license to exist inside a corporate ecosystem. This is not a conspiracy theory. It is the prevailing macroeconomic model of the 21st century. Over the last 2 decades, a quiet, hyper-calculated restructuring of global capital has taken place. The foundational pillar of Western civilization, private property, is being systematically dismantled and replaced by an inescapable system of digital feudalism. Through a combination of software locks, predatory financialization, and manipulated corporate law, the very concept of ownership is dying. And the domino effect triggered by this transition is quietly stripping real wealth, autonomy, and sovereign independence from billions of people permanently. To understand how this trap was sprung, we have to look back to the early 2000s, when a subtle shift in contractual language quietly redefined consumer law. Historically, when you purchased a physical object, whether a car, a piece of heavy machinery, or a record player, the doctrine of first sale applied. Once the transaction was complete, the property rights transferred entirely to you. You could tear it down, repair it with third-party parts, or sell it to your neighbor. Then came the microchip. By embedding proprietary software into physical hardware, corporations unlocked a devastating legal loophole. Under global copyright law, companies can maintain absolute intellectual property over the software operating the machine, even if you physically own the steel, aluminum, and rubber surrounding it. Consider the modern agricultural sector. An industrial tractor costs upwards of $800,000. Yet, when an American farmer purchases one today, they are forced to sign an end-user license agreement that explicitly restricts them from accessing the vehicle's diagnostic software. If a minor sensor fails during harvest season, a delay that can cost hundreds of thousands of dollars in ruined crops, the farmer is legally barred from fixing it themselves. They must wait days for an authorized technician to plug in an official laptop and clear a software code. The farmer owns the debt on the tractor, the liability of the tractor, and the depreciation of the tractor. But the corporation retains total operational control over the tractor itself. This was the initial domino. Once corporate legal teams realized that software could be used as a Trojan horse to restrict physical property rights, the model spread exponentially across the entire global economy. In consumer electronics, the shift was swift and brutal. Tech giants pioneered serialized parts pairing, embedding digital microcontrollers inside individual components, batteries, screens, logic boards, ensuring that if an independent repair shop attempted to swap a broken display, the phone would deliberately deactivate key functionalities. The physical object in your hand became a walled garden, designed not for durability, but for forced obsolescence and perpetual cash extraction. Automotive manufacturers quickly followed suit. What was once an asset that conferred total personal mobility has been transformed into a rolling subscription platform. Luxury automakers now manufacture cars with fully functional heated seats, advanced steering systems, and higher capacity battery packs built directly into every vehicle on the assembly line. But those physical features are intentionally disabled by software at the factory. To unlock the physical capability of the hardware you physically paid for, you must pay a monthly fee. If you stop paying, the feature vanishes over the air overnight. The systemic implications of this are staggering. By decoupling utility from physical possession, capital has effectively eliminated the secondary market. If a vehicle's features are locked to a recurring subscription tied to a user account rather than the chassis, the resale value of the physical object collapses, destroying one of the primary mechanisms middle-class households use to store and transfer wealth across generations. And yet the loss of physical hardware control is merely the entry point to a far more dangerous macroeconomic shift. While consumer goods were being locked behind digital paywalls, an infinitely larger pool of institutional capital was quietly targeting the single largest store of human wealth in history, real estate. In the aftermath of the 2008 financial crisis, an unprecedented structural change occurred in the global housing market. Private equity firms and institutional asset managers realized that low interest rates and stagnant wage growth created a perfect environment to execute a massive, systemic asset sweep They didn't just buy mortgage-backed securities. They began buying single-family homes directly off the market by the thousands. Equipped with algorithmic buying engines capable of evaluating thousands of properties per minute, institutional capital outbid traditional families, paying cash above market rate to systematically absorb residential real estate in high-growth metro areas. In dozens of American suburban neighborhoods, institutional investors quickly came to own over 30% of all single-family homes. The goal was not to flip these houses for a quick profit. The goal was to convert residential real estate into a permanent asset class yielding fixed, perpetually escalating rental income. When a family buys a home, they lock in a fixed cost of living, build equity over 30 years, and eventually pass a debt-free asset to their children. That equity serves as a financial firewall, a pool of private capital that can fund small businesses, absorb medical emergencies, or insulate families from economic downturns. When an institutional asset manager buys that same home, the equity is permanently removed from the public sphere and absorbed into a corporate balance sheet. The family becomes a lifelong tenant, paying a perpetual subscription fee just to have shelter. A fee that inflates every single year to meet Wall Street's yield expectations. The wealth-building mechanism is inverted, sucking capital upward from the working class directly into corporate treasuries. The domino effect is mathematically brutal. As institutional buying drives home prices beyond the reach of median earners, a massive structural shift occurs. The percentage of population forced into perpetual renting explodes. Demand for rental units skyrockets, driving rent prices higher, which further reduces the average family's ability to save for a down payment. The trap springs shut, creating an inescapable economic loop. Why is this happening now? Why has the entire global economy pivoted from selling goods to renting access? The answer lies in modern financial metrics. On Wall Street, corporate valuations are no longer driven by traditional profit margins or physical asset holdings. They are driven by a single metric above all others, annual recurring revenue, or ARR. A traditional manufacturing company that sells a product for $100 makes a one-time profit. Its revenue is unpredictable, subject to consumer demand cycles, economic recessions, and market saturation. As a result, stock markets evaluate that company at a low valuation multiple, often just 1 to 2 times its annual revenue. However, if that same company converts that product into a $10 a month subscription, its revenue becomes predictable, contractual, and perpetual. Wall Street rewards this recurring revenue with astronomical valuation multiples, frequently 10, 20, or even 30 times annual revenue. This financial dynamic creates an irresistible corporate imperative. Boardrooms are structurally incentivized to eliminate one-time sales entirely. To survive in a financial system governed by Wall Street algorithms, every corporation must transform itself into a toll collector. Software companies were the first to make this transition, abandoning lifetime software licenses in favor of perpetual monthly SaaS subscriptions. Cloud storage replaced local hard drives. Streaming platforms replaced physical media libraries. Today, you do not own the movies you watch, the music you listen to, or the software you use to run your business. You are paying for temporary access to a remote server farm, an access rights agreement that can be modified, price hikes, or terminated at any time without your consent. Now, that exact same financial logic is being aggressively applied to every physical asset in existence. Hardware is a service. Mobility is a service. Housing is a service. We are rapidly approaching an economic equilibrium where the entire material world is owned by a concentrated network of institutional capital platforms, while the global population exists as a permanent tenant class, paying a monthly tax on every aspect of daily life. Consider the terrifying terminal state of this economic trajectory. When you own nothing, you have no leverage. If you breach the terms of service of a cloud provider, your digital identity, photos, and professional documents disappear in an instant. If your vehicle software is locked to a centralized network, your physical mobility can be restricted at the discretion of a corporate board or a regulatory authority. If your housing is controlled by a portfolio algorithm, your shelter is contingent on your continuous submission to escalating market rates. The loss of ownership is not simply a shift in consumer preference. It is a fundamental transfer of power from the individual to the institution. It eliminates the economic cushion that historically allowed citizens to take risks, challenge established structures, and maintain personal sovereignty. Without private property, the citizen ceases to be a citizen and becomes a permanent dependent subscriber to the modern corporate state. The system is already fully operational. The incentives are aligned. The infrastructure is built. And as the final legal and digital barriers fall, the world where you will own nothing is no longer a distant theoretical scenario. It is the exact economic reality being constructed around you right now.